If you've ever sat down after a long shift, exhausted, maybe a little frustrated, and thought, I worked incredibly hard to get here, so why does it feel like I'm still one bad month away from financial stress? This video is for you because that feeling, I know it well. I went through all of it. The years of training, the student loans, the delayed gratification, and when I finally made it to attending level income, I assumed the hard part was over. It wasn't. And here's what I want to show you today. I want to show you exactly why I made the decision to start building income and wealth outside of medicine. Not to abandon medicine, I love what I do, but to stop depending on it as my only financial lifeline. Because here's the truth that nobody teaches you in graduate or medical school. Your income is not the same as your wealth. And your clinical salary, no matter how large it is one of the most fragile assets you own. In the next 8 minutes, I'm going to break down the real financial risk of hiding inside a medicine only or a single W-2 only income strategy. I'm going to show you the exact mindset shift that changed everything for me. And I'm going to walk you through the framework I used to start building passive income alongside my clinical career without becoming a landlord, without quitting medicine, and without taking reckless risk. So let's get into it. Let me start by busting the biggest myth that most physicians carry around without even realizing it. The myth goes something like this: I make a great income, so I'm financially secure. And I get it. According to the 2026 Medscape Physician Compensation Report, the average physician in the US earns about $386,000 a year. Specialists average closer to $417,000. And that sounds like security. But here's the reframe I want you to sit with. Your income is not your wealth. Your income is a stream, and that stream only flows as long as you keep showing up. Think about what happens if you can't show up. Burnout. The American Medical Association has reported that nearly 50% of physicians experience at least one symptom of burnout. White Coat Investor has written extensively about this, and their conclusion is stark. Burnout is not just a wellness problem, it is your single biggest financial risk. If burnout forces you to cut back, leave a position, or step away from practice, even temporarily, your income stops. And if your income is your only financial engine, everything stops with it. And it's not just burnout. What about malpractice? A policy change in reimbursement overnight, a health event of your own, God forbid, a shift in hospital employment contracts. These are not theoretical risks. They happen to real physicians every year. And here's the deeper problem. According to White Coat Investor data, approximately 25% of physicians in their 60s are still not millionaires, despite decades of high income. And 11 to 12% of doctors in their 60s have a net worth of less than $500,000. How does that happen? Student loans that average $200,000 to $300,000 at graduation. I myself had $386,000 and often balloon higher. That's one factor. A late start to investing, lifestyle inflation that quietly consumes every raise, and the biggest one, a complete dependence on a single income stream that never gets diversified. The problem isn't that physicians don't earn enough. The problem is that most physicians are running a one-engine plane, and I decided to build a second engine. So what changed for me? It started with a simple question. I asked myself, if I couldn't work for 6 months, what would happen to my finances? And the answer was extremely uncomfortable. And that discomfort was the catalyst. I started researching on how other high-income professionals, not just physicians, were building wealth that didn't depend entirely on their ability to show up and work every day. And I kept running into the same answer: real estate. Now, before you picture yourself fielding 2 a.m. calls about a broken water heater or toilet, stay with me, because the version of real estate investing I'm talking about looks nothing like that. Here's the framework I built step by step. So step 1, understand the difference between active and passive income. Active income is what you earn when you work. Every W-2 is active income. Passive income is what flows to you whether you work or not. And medicine is almost entirely active income. Now, the goal of investing outside of medicine is to build passive income streams that compound over time, so that eventually your financial life isn't entirely dependent on your clinical schedule. Step 2, accept that your time is your scarcest resource. This is critical because it shapes every investment decision you make. As a physician, you don't have 40 hours a week to manage rental properties. Ain't gonna happen. You don't have time to become a full-time real estate operator. So the strategy has to fit your life, not the other way around. Step 3, learn the asset classes that work for busy professionals. For me, this meant focusing on passive real estate investment, specifically investing as a limited partner in real estate syndications, where a professional operator manages the property, handles the tenants, executes the business plan, and you, as the investor, simply provide capital and receive a share of the returns. And according to CBRE's 2025 U.S. real estate market outlook, multifamily real estate, which is apartment communities, remains the most preferred asset class among commercial real estate investors. The vacancy rate is projected to fall to 4.9% in the year 2026, and CBRE projects average multifamily rent growth of approximately 2.8% annually over the next 5 years, above the pre-pandemic average. Meanwhile, Marcus and Millichap's 2026 multifamily outlook confirms that long-term fundamentals remain solid, with construction starts down 53% from their 2023 peak, meaning supply is tightening right as demand stays strong. Now, people always need somewhere to live. That's not a trend, that's just a permanent human reality. Step 4, understand the tax advantage. Now, this was the part that genuinely surprised me when I first learned it. When you invest in real estate, the IRS allows you to deduct depreciation, a paper loss that represents the gradual wear on a building over time. This depreciation flows to you as an investor and can significantly reduce the taxable income that you report from that investment. Now, many operators use a strategy called cost segregation. This is a formal tax study that accelerates that depreciation into the early years of ownership. And according to KBKG, which is a leading tax consulting firm, cost segregation studies can generate substantial first-year deductions that can directly reduce your tax bill. Now, what that means practically is this. You can receive real cash distributions from a real estate investment, and after that depreciation is applied, your taxable income from that investment could be near zero, or even show a paper loss that can offset other passive income. For a physician, usually in the top tax brackets, that's a powerful advantage that a standard brokerage account simply cannot replicate. Step 5, start small, stay consistent, and scale. You don't need to bet everything on your first deal. The goal is to build familiarity, build relationships with quality vetted operators, and then let the compounding effects of multiple investments work over time. Now, let me address the concerns I hear most often because they're legitimate. I don't have time to learn all of this, and I hear you. And I want to be honest, there is an education curve, but it's not as steep as medical school, law school, or engineering school. You're not learning a new clinical specialty. You're learning a framework. And once you understand the fundamentals, how deals are structured, how to evaluate a sponsor, and how to read a private placement memorandum, the process becomes more manageable and more plug and play. The initial investment of time pays dividends for the rest of your career. What if I lose money? Real estate carries real risk, and I want to be clear about that. Values can decline, deals can underperform, weird pandemics can come out of the left field. The most common reasons are over leverage, poor market selection, or a sponsor who simply didn't execute. And that's why due diligence on the operator, what's their track record, their experience through multiple market cycles, not just the nice, awesome times, but the tough markets. You want to see how they perform. Their alignment of interest, as long as it's aligned with their investors, is the most important work you do before writing any check. And diversifying across multiple deals and operators also reduces concentration risk. Is now even a good time? Here's what the data says. According to the Federal Reserve's economic data, inflation ran up to 8% in 2022 and cooled down to about 2.9% in the end of 2024. But the cumulative impact is that the purchasing power and the changes in it is permanent. Sitting in cash or in low yield accounts is not a neutral decision. And meanwhile, CBRE projects multifamily rents to grow approximately 2.8% annually through the end of the decade. And Marcus and Millichap notes that investors who enter the market just after peak cap rates historically realize some of the best returns of the cycle. That window doesn't stay open forever. Now, let me paint you a picture of what consistent action looks like over time. Imagine 5 years from now, you've invested in 2 or 3 real estate deals alongside your clinical income. You've been receiving quarterly distributions, passive income the entire time, and you've gotten Schedule K-1 tax documents every year in March that have reduced your annual tax bill in a meaningful way. And now that the first deal is selling after about a 5-year horizon, and you're receiving your original capital back, plus your share of appreciation and profit. You haven't managed a single tenant. You haven't taken a single maintenance call. You've simply been a capital partner in a professionally managed asset. And here's the scaling formula. If you invest in 1 deal per year, even at a modest investment level, and each deal performs at a conservative 10 to 12% annualized return over that 5-year hold, you're building a portfolio that generates income independent of your clinical schedule. And that's not fantasy. It's not a far-fetched dream. It's simple math. And more importantly, it's freedom. The freedom to practice medicine on your own terms or your own profession, whether it be law or whatever it may be. You can take a sabbatical if you need one. You can cut back without financial panic. You can buy back your time, as they say in the White Coat Investor, to make career decisions from a position of strength and not desperation. And that's why I started investing outside of medicine. Here's my challenge to you this week. Don't let this video be something you watch and move on from. Take one concrete step. Read one article on passive real estate investing. Look up what an accredited investor is and whether you qualify. Ask one question. And that first step of education is what separates the professionals who build lasting wealth from the ones who keep wondering why their income never translates into financial freedom. And when you're ready to go deeper, I built something specifically for you. Head over to www.cardia.com. Link is in the description. There you can download 2 free ebooks, one about taxes, one about syndications, that I've put together for busy professionals who want to understand passive real estate investing from the ground up. And more importantly, you'll also find a completely free 9-part private training action guide called the Passive Investing Action Guide that I created. Inside that training, I'll walk you through the exact framework that experienced investors use to build long-term passive income through real estate. And we cover how to evaluate deals, how to vet sponsors, how to understand the tax benefits, and how to build a portfolio that actually fits the life of a busy professional, not a full-time real estate operator. It is completely free. There's literally no strings or catches. I wish I would have had this when I started. And it is built specifically for professionals, physicians, and other high-income professionals who want conservative, long-term passive income without becoming landlords. This is not a get-rich-fast scheme at all. If you are serious about building wealth that works while you sleep, wealth that gives you options, gives you freedom, and gives you ability to practice medicine or your primary job because you want to, not because you have to. And that's the best next step is waiting for you right now. I'll see you there, and I'll see you in my next video.